Hey, y'all. Welcome to episode 78 of Gabfocus. My name is Tommy, and I am your sole host today. My girl Melissa has a family thing, and she's not going to be able to join us today, but we're going to have a good time without her today. I'm going to jump right in because we got a packed agenda. 78th episode, really fun here. Self-storage finances 101. I've got two really incredible people. So to my left here, Amber from Live Oak Bank. Welcome to the stage, my friend. How you doing?
Thanks, Tommy. Good. Good. Happy to be here. Thanks for having
Glad
me.
to have you here. So you've been in financial finances in like for 10 years, Live Oak for 7, and then self-storage concentration for 4. Is that right?
Just about, yeah. So
Just
I was
about.
in a very different type of finance than lending prior to lending.
Yeah.
Came to Live Oak going on 7 years ago and storage team going on 4, yeah.
All right. What's your favorite thing about self-storage?
The people. I know everybody says that, but it is so true. It's a really good mix of people from all different backgrounds, kind of getting into the same thing. Everyone's so excited about it. It's just it was a really easy industry to feel a part of when I started.
Well, if everybody says it, it has to be
It
true,
has to
right?
be
Like majority
true. Yeah,
rules. Isn't that how that works, right? Like, we are a democracy.
exactly.
Isn't that how democracy works, Brooks?
The earth was flat
Uh,
for a long time by that logic.
the no, but what you said, I love, absolutely love. People get so jazzed and excited and like passionate about this industry, which is it's fun. It's kept me jazzed and enthused going on a decade. So welcome to the stage, Amber. I'm stoked to have you, and I know the audience is gonna love hearing from you. And then to my right, my one and only Brooks Lumpkin. Welcome to the stage, my friend.
Thank you.
I've known you for many, many years, and you're one of the so-called nepo babies of self-storage. This man was born in blood in 1982. His dad started, self-storage in the 70s, I believe, and here you are now. You bought your first official facility in 2015, so going on a decade now.
That's right.
Well, welcome to the stage, my friend.
Thank you.
Yeah, glad to have you here. So, to give the audience your brief background besides that, right? So, how many facilities you own today, and what makes you such an expert in all things finances?
Um, we've got about 15 facilities that I own and operate under the flag Flex Storage. Um, and then we have developed with some partners a handful of other facilities, mostly in Florida, that CubeSmart runs for us. And so I like the fact that I can kind of cheat off their paper. I get to run my own management machine and I get to fight my own battles. And then when I don't quite know what I'm doing, I kind of look over the fence and see what CubeSmart's doing at those stores. And so and then my father's also still in the business, and so I get to cheat off his paper as well. So when you say I'm an expert, I'm a reasonably effective uh, plagiarist. That's pretty much it.
Aren't we all plagiarists, though, if you think about it?
Hey, we could get into an interesting discussion about AI, right? I mean, that's plagiarism is all there is.
Yes. Well, hey, man, I'm glad you're on the stage. I think the audience is going to love what you have to say. I've always loved hearing your perspective on things. I've heard you speak, I've heard Amber speak. So I'm excited for the Gap Focus audience to hear both of y'all speak. So, welcome everyone to the party today. Real quick, Gap Focus, of course, is brought to you by my team here in Knoxville at StoragePug and Melissa and Josh Huff over at Lighthouse Storage Solutions. The Cat Focus setup is this. If this is your first episode, welcome. I see many familiar names, but I'm glad y'all are here. We're going to go for about an hour. We got a very, very deep agenda today. I have questions that were submitted before the show. They were sent and emailed over to us. And again, shout out Garrett for curating those. And then, of course, use the live Q&A tool to ask your own questions during the show in real time. We'll be monitoring the Q&A. So today's agenda looks like this. Very awesome. We're going to talk about, hey, how do you go about checking the financial health of your storage business? How do you track revenue? How do you track expenses? And then ultimately, why we do all of this is how do you invest and how do you grow and how do you get better? So without further ado, I'm going to start with my first question here. So this one I'm going to throw to Amber, because you consult with a lot of folks who are, I would say, in the green bean category, right? How can I tell if my storage business is healthy? Just start there for me.
Yeah. I mean, I think so from a lender perspective, most of the time lenders are looking at cash flow. That is one key indicator. I mean, you've got your actual facility management too. But from the cash flow perspective, NOI and net operating margin, healthy margins, I think is really important. If your revenues and your occupancy are trending in the right direction, are your expenses well managed? How often are you increasing rent? So are you kind of operating a hands-on business? And then kind of, I think stepping back from that a little bit, just kind of your day-to-day stuff, like do you have good security at your facility? Do you have good tenant feedback and good tenant reviews? Um, and I think on top of that too, low late fees and good collections. I think so. Just I think showing that you are active in your management of your facility can really help show that your business is healthy.
I mean, each of those things, I mean, you rattle off reviews, NOI, tracking expenses, is your security up to notch, right? Like, what's your late fees and delinquencies? All of these things we can like chase the rabbit so deep down all of those. But what a great way to start this episode. Brooks, I'm gonna throw the same question to you, right? And then I love in your intro, you mentioned you have your own 15 facilities, you've got some partnerships where you're CubeSmart's managing. How can you tell if, honestly, from your perspective, the 15 flex stores and then the ones that are managed by CubeSmart, how can you tell that your storage businesses are healthy or not healthy?
Um, Everything Amber said is right. And then there's a pyramid of other specifics under that. I was actually going kind of higher on the pyramid. I was going to say if I had to know in a snapshot, is the occupancy between 85 and 95%? Is the in-place revenue growing or shrinking? Um, are you having enough move-ins, each month over the last 3 months to replace your move-outs? And you know, I mean, th those three really would probably give me the ability to um, have a pretty good sense of the health of a facility in a snapshot. And then, like you said, there's an infinite number of rabbit trails to go down of why. If the answer is no, why?
I love that. So how often are you asking yourself those three questions, or is this more of like a, as needed, I review myself?
Yeah, we have a daily summary email that goes out every morning, and that email highlights these fields and some others. And so I kind of, if things are working right and I'm paying attention, I have a kind of daily series of alarm bells that go off if things are trending the wrong direction. And ongoing is the correct answer to that question. At no point should you not be aware of your occupancy, your revenue trend, and your occupancy trend.
Love that. So it's an ongoing thing. You should live and breathe this to some degree, is what I'm hearing you say. So you mentioned it, like you're watching these trends. What are some early signs that might make you worried or maybe make you want to look a little bit deeper?
Um, thinking back over the last few years, um, it took a little while for us to figure out at the beginning of COVID that all our stores were getting full and we probably weren't asking enough. We thought we were just really good because, man, surprise, surprise, we rented, more units than usual in, February and March and April. And, must be our talent and ability. And then so I'm making fun, right? We didn't quite understand what was happening. And then similarly on the far side, Extra started cutting rates at a time when our occupancy was still very strong. And I was thinking, man, what are those bozos doing? Well, a year later, I see that our occupancy is declining. And it took me really probably another year from there to get aggressive enough to fully halt that occupancy decline. So being aware of it, knowing how to fix it are two different things. But you probably have to do the first to do the second. And I would say anything if you run multiple stores and you see any trend spreading across more than two or three stores, that should be a real that should be a version of an alarm bell. And if you just run one store, I think you probably don't want to respond to any single month trend, but you probably want to start paying attention if anything goes past maybe a 3 month trend.
Yeah, well, there's a director of marketing at Argus, Jason, who gave me a really cool quote once. He said, 1 month, not a trend. 2 months is on its way to being a trend, and 3 months is definitely a trend.
Yeah.
So mirrors exactly what you just said. So that's good tips there. Amber, I guess you mentioned you rattled off so many awesome stats and things that signs that you're doing a good job at your storage business. What are the absolute necessities? What are the biggest metrics that if I'm an operator, I should absolutely be tracking, whether it's an ongoing basis or monthly, quarterly, what have you? What are these absolute necessities in your mind?
Yeah, I mean, I think again, a lot of it comes down to cash flow, but at the same time, um, there's a lot that Brooks covered on too that I think is important to point out. So, revenue and expenses, obviously, I think every operator, depending on what type of facility you have and how large it is, what your operational strategy is, those expenses are going to look a little bit different, especially with the
Mm.
uncontrollables in there. But making sure that your, I think, net operating margin is in line with where it needs to be, to cover your debt, to bring in additional income, and then occupancy, just keeping an eye on those trends to make sure that you are trending in the right direction. If not, kind of trying to problem solve to figure out why. So anything month over month, year over year that you can track on reports like management summaries and occupancy reports, financial reports, I think are really important. And on top of that too, move-ins, move-outs, and just new leads that you have come into the system, I think are also a great indicator.
Yeah, I was just about to ask you what reports do you suggest, and you mentioned several great ones there, right? Your management summary, your move-ins, your move-outs. There's a cash flow report. Those are all killer things. So, what tools are available for an operator to track these things?
I think, I mean, as far as tools for the reports.
Mm-hmm. Yep.
So everybody does it a little bit differently. As far as your P&L is really concerned, I've sometimes worked with people who are like back of the napkin math. They really have a very good handle on their expenses, or their expenses may be really low if they kind of self-manage and operate the facility that way. Um, Sometimes people work with QuickBooks. Sometimes people are using other kind of built out software specific for self-storage. So it kind of just depends on, I think, the operator. Um, but there are a lot of different options there for tracking your revenue and expenses. And then obviously those other reports as well that you're running through those
Yeah.
your software really.
Huh. So, Brooks, at your scale at 15, does your reporting look different today than it did in 2015 when you had your first facility?
Hey, you're coming into a space that is a passion of mine. Our reporting is so different that it is not even comparable. I've always been a bit of a data nerd, and I was digging in the reports harder than others and exporting things to Excel and trying to find patterns and work with the data. Storage had some really interesting tools for allowing you to look at or allowing you to manage your rates through Excel, which was great. We've got a full-time programmer and data science guy who is I think just absolutely amazing. And we probably dig deeper than most portfolios of, say, anything less than 500 stores. I think the huge guys are probably better than us because they've got the scale and the statistical significance, but we dig in really deep. Now, the problem with most of that digging is that a lot of it is inactionable. You
Mm,
find stuff and you see stuff and you think, oh man, this is amazing. But, okay, I'm paying too much for spare foot. Well, you cut spare foot and then 3 months later well, hold on, now we need more spare foot. So just because you have a ton of data or a ton of reporting doesn't mean you can always make the right decision. So there's two different variables there,
I see. I
and
see.
and it's easy to get lost in the data. I think if for most of the people watching this, presumably they don't have a data science guy, and even if they did, I don't know their decisions would be much improved. So I would say for most people running one or two stores, stay focused on the fundamentals. Every phone call matters. Every point of contact on your website matters. Every existing customer matters. Take care of if you take care of the ounces, the pounds take care of themselves. And hiking and football, pay attention to the inches and the yards take care of themselves. So I think that a lot of times the execution just boils down to doing the basic stuff right over and over again. And That's probably the best advice I can give myself and others in most of these situations.
Chef's kiss, man. No, I was just notating that because I think that was a beautiful answer because it's easy to get lost in the sauce, you know, especially if you lean towards like the love and the data and the numbers and all of those things. And it's easy to get lost in the sauce where if you just focus on the fundamentals, like that's most of the game. Like most of the returns are from answering the phone properly and every time, and asking the right questions when the tenant comes in, and like you mentioned, having an ongoing process, whether it's an emailed report or you're logging into your software, or like Amber saying, like you've got all these P&L tools, that there's an ongoing process of eyeballs on the business, eyes on the prize. So I really love that. So I'm gonna shift gears a little bit and talk about budgeting. So give me a rough breakdown. What does budgeting season look like for self-storage, right? So I would imagine that most businesses have 2026 budgets done by now, maybe. I would like to think so, or at least an outline of the budget. But like, what does that process look like for a self-storage business, or does it not matter for a self-storage business? Here, let's start, Amber. I'll start with you, and I'd love Brooks' take on that too. What does budgeting look like in self-storage?
Tough. I mean, like I feel like it's tough to um it's not the same as a lot of other traditional business ownership whenever you're budgeting for self-storage because you do have your uncontrollables, you have your taxes and your insurance, both of which are going to shift. Uh, Sometimes you can't prepare for those shifts, like we saw. A lot of projects in Texas have a huge kind of unexpected insurance increase because of the storms. So there are some things that you really can't plan for and you can't control. Um, I mean, as far as your budget goes, really whittling down your expenses to what makes sense for you and your facility and your team. Having a really strong built-out team like Brooks does, I think is incredibly important, especially once you do get into that kind of middle market area of ownership. So, um, having a good handle on payroll, staff, and management, making sure that that's the right fit for your business. So I think that budgeting is really tough ultimately because your expenses could be at 20%, they could be at 50% of your total revenue, just depending on how you operate your business. However, cheapest and lowest expenses does not always mean that you're making the best choices. So you really kind of have to weigh options and make sure you're working with good people to budget as best as you can.
Yeah.
Um, so first, let me criticize the question. I don't believe in budgets. I think if you need to
No, you're a
spend
man after
money,
my own heart. I can't wait to hear this.
if you need to spend money, you spend the money. And if you don't need to spend money, you don't spend the money. I don't give a crap if it is in your budget one way or the other. I mean, you just gave the example of your insurance premiums. What am I going to do? Call the
What are you
insurance
gonna
company and be
do?
like, I'm
Yeah.
sorry, it's not in the budget. Like I can't absorb this increase, or my property taxes went up, or
I love
my
it.
manager gets
I
sick or
love
goes on
it.
maternity leave. What am I going to
There's
do?
no general liability for the rest of the year.
Yeah,
Yeah.
so I
Yeah.
think budgets are the stupidest idea in the world because I think you spend money when you have to and not when you don't. And so
Oh,
now that said, we do projections. And so, it's the same thing, right? We do want to look forward and say, hey, what's our revenue trend? What's our we do a rolling 12-month projection. So we meet monthly and we have the last 12 months on the left and we have the next 12 months on the right. And we can kind of say, hey, here's the constant kind of look feel for the whole. And uh, you know, CubeSmart provides us with annual budgets. This is the time of the year they've sent those budgets out, and they have all sorts of numbers in there about next year's effective, occupancy and rate. Well, am I going to call them up in July and say, "Oh, your rate's too low or too high"? Absolutely not. They have a daily algorithm where they're adjusting all that stuff, hopefully, to the best of their ability. And so, I don't want them to stay true to the budget. I want them to make the best decision they can every day, and
yeah.
that's my spiel.
No, I love it. You're a man after my own heart because we've been running StoragePug for nearly a decade, and I've never once had a budget for StoragePug. If we need to spend money, we got to spend the money. And if we don't have to, let's leave it in the bank. Let's
That's
give bonuses and raises. And
yeah.
now I'm not suggesting you should be loosey-goosey about your business. We do have projections, right? Like we do kind of have an idea of what we're going to spend, but we don't have like no one's counting the beans to see how many beans we spent this month and how many we thought we were going to spend, right? And I think like self-storage is probably one of those businesses that is okay to operate that way, to some degree, right? As long as you're doing some of the other things that Brooks and Amber have talked about here. So I love that. One thing I do want to comment on, and you mentioned the whole, actually the insurance, property taxes. How do you deal, how do you absorb an unexpected expense that is 20, 30, 50? I talked to an operator in North Carolina. Their property taxes went up 136% year over year just because they hadn't been assessed in so long, right? So like how how do you handle something like that as an operator?
I mean, we could do an hour and a half on this, but it's a little bit like how do you handle it if your house, gets knocked over in a storm? I mean, you make the most of it, right? I mean, your options are I don't have the money, I have to go borrow it. I, can not put that roof on that I need, or I can fire my manager and go down there and manage it myself. I mean, you're in true triage mode if you don't have the cash on hand and you hadn't prepared for that in your long-term expenses. Um, you mentioned storage as a business that, may or may not need budgets. I will say that in the grand scheme, storage is one of the more stable and predictable businesses in the universe. And I, if your property taxes go up 136%, you should have contemplated that possibility. Now, it might be painful for you, but you should have been looking around. I have facilities where the property taxes have not been increased in 10 years.
Mm,
And at some point, somebody is
hammers
going to call
dropping.
me and the property taxes may go up 300%. And when that happens, I'm going to say, thank you, Lord, for the last 9 years. I'm not going to say, how dare you? And so
Oh,
I hope that person has looked around and prepared for that possibility. And
that's a refreshing take, man. That's a very grown-up take.
I mean, I'm not going to let them go higher than they need to, but what am I going to do? Call up and say it's not fair that you've raised my property taxes? If the value's gone up, the property taxes are going up.
Yeah.
It all, I mean, it's almost like if your gate was broken, if someone ran through your gate and it wasn't in your budget to fix this gate whenever it was broken, is it still something that you're going to fix because it's a necessity versus,
Yeah. Probably going to fix it.
probably
Or,
going to fix?
yeah.
So,
Now,
Yeah.
Tamara has got a great, and I love this comment from Tamara here. So please be aware, and maybe Amber, you can speak to this to some degree. Please be aware if you have financing or need financing, the bank will probably need you to have some sort of budget or projection. So can you speak to that, Amber, to some degree?
yeah, no, of course. So I think it absolutely 100% Tamara's right. So it kind of depends on what type of project you are looking at. So if it's an acquisition, you've got some seller historical financials. However, if it's like a turnaround acquisition where it's been mom and pop managed and they haven't fixed anything in 10 years and they haven't raised rates in 10 years and they haven't, and you're really dealing with a pretty big lift, it is going to look a little bit different than if we're looking at a ground up construction,
Mm,
from nothing build. So on both sides, we do need some sort of some understanding of the budget, and projections so that we can understand how to size the loan because banks like collateral. They like to be fully collateralized. Self-storage very often will fully collateralize the loan, but that collateral is not paying the loan back. I
no.
care about, where the money is coming from, which is ultimately your NOI, and the expenses are going to play a big part of that. Your revenues can only go up so much. Your gross potential income is only going to be so much, especially if there's any kind of new supply that comes into the market. So really the budget is, it is best guess. Typically from, I mean, especially if it's ground up construction, we're working with feasibility study experts that, really know what they're looking at. I think both nationally and kind of in comparison to
Mhm.
that micro market where the project is. So yes, we definitely do need a budget. We do need projections, but at the same time, I fully see, Brooks's point of if you've got to pay for it, you've got to pay for it. R&M may be huge one year, taxes may increase, insurance may increase, and you just kind of have to shift and roll with the punches.
Yeah. No, the Tamara. So great comment and great take, Amber. I think you're right. And also, I think the ability to speak to those numbers just indicates that you are knowledgeable of your business, right? And I think that's an important trust building and also confidence building if you want to go and get the loan or bring on a business partner or a capital partner. I think all these things help you. And even if you're not just trying to raise money, it also helps you to like know how to run your business better. And all of that is only going to be a good thing.
Uh, Tommy, Camille also, she had a similar comment to Tamara. She said, I think it's nice to have a budget, but you have to be able to pivot. You know, I like speaking hyperbole because it draws out a reaction, but we don't budget, we project, right? And it's the same thing. It just somehow in my mind, if somebody says, "Oh, well, our budget allows us to spend $1,000 on whirligigs," I'm like, "Whoa, whoa, 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 whoa! Do you need the whirligig? Answer that question first." And so projections and budgeting, it's similar. And then to Amber's point, if you go for financing, they want your projection, then they want the appraiser's projection, then they want a feasibility studies projection. And now let me take it back to kind of some general rules of thumb. There was another question here about what's the ratio of income to expenses, and I think we're going to get to this, but I find that for years and years and years in the storage industry, 35% was a very good estimate of expenses against stabilized revenue, not necessarily current revenue, but stabilized revenue. I think in the last few years that number's gone to 40%. It's
Wow.
I don't have a single store with reasonable property taxes that I can run below 40%. And now I have to reference another comment. Amber mentioned that sometimes running your store as cheap as possible is not the best way to run your store. So we do not run our stores as cheap as possible. But as a rule of thumb, your stabilized revenue, 40% of that is going to go to OpEx. And so again, just that quick sniff test, if your operating expenses are way above 40%, then I think you got to spend a lot of time staring at your expenses. And if they're way below 40%, uh, I'm fascinated to understand what you're doing.
Love that take. So break that down for me, right? So the 40%, what does that comprise of, right? Or 35% or what have you, right? So like what are the major categories of expenses that as an operator I should be mindful of?
Um, you you asked me some of that in advance, and I had done some work on that. So let me here's my breakout. I could paste this into the chat if it's helpful.
Actually, yes, that would absolutely be helpful. Paste
Okay.
it.
If it's I'm going to paste it in the
I want the
chat.
whole audience to follow along here.
Okay, well,
Yes.
this is also I did these in integers because I didn't want to be speaking in tenths. Uh, Here is my
Very data driven.
I love it. I
Impressive.
love it. I love it. Okay, now we're talking. I'm actually
so
going to share my screen and pull this up on the screen because I think this is awesome.
Um,
Um,
so again, we're running, we're looking at our stores and trying, and these are averages across our portfolio, and these are tweaked and cleaned, and nothing's perfect here, but this gives you an idea. Basically, your top two expenses are payroll and property taxes, and then it kind of goes down from there. That management fees item I've got listed at 7%. Some of you aren't using a management fee company. And I can almost guarantee that you're spending 7% of your gross revenue in the form of your time running your store. And then some of you have a management company and you think you're paying them 4 or 5 or 6%. You are not. You are paying them more than 7%. You're probably paying them something like 9 to 14% of your gross revenue if you really add up everything you're paying them. So the management fees line is soft, but it's uh, you know that's a very large portion of your expenses. Utilities, that's heat and water and whatever else. 4%. If you had a non-climate facility with no lights, maybe you have a near zero electrical bill, but 4% is a reasonable ratio. Merchant processing, that's 2% for credit cards, 2% for repair and maintenance, 2% for general admin, including your software, and then a bunch of 1% lines I won't read out. But that's the way these are kind of our right down the middle numbers.
wow, this is killer. This is the first time I've seen it break down so cleanly, and I love it. Makes my heart happy. Um, Amber, your take on this. What else would you add, or what would you tweak, or is this what you typically see?
No, I mean, I think the breakout is pretty benchmark, but it's tough to, I think, say that expenses are benchmark because it really
Mm.
depends on how someone runs their facility. I've seen some operators that have a super straightforward boat and RV facility that are capable of running it at 20% expenses because they don't have, all of these line items that they have to worry about. I've seen some owners that, are very bootstrap, will do everything themselves, will do the leasing themselves, will run it themselves, overlock it themselves. And they may be running it at closer to 20 to 25% expenses. I would say typically for as far as benchmark, especially for larger facilities, portfolios of facilities where you do just have more admin, you have more management, you have more fees associated with that's kind of that size, that portfolio size, anywhere from 35 to 45%, I think we see relatively often.
Okay. Yeah. Brooks, you passed the test. That's awesome. Thank you for sharing that, by the way. And I just slapped that in the spreadsheet for the audience there, and I shared it in the chat. Feel free to save it, y'all. That's a really cool breakdown to see. And to both Amber and Brooks' point, I think there's a lot of dependencies, right? Some markets might have higher property taxes, some might be lower. Some you might have higher marketing costs because you're in a different market, right? Or maybe you have less landscaping or more landscaping or what have you. So there's lots of variability there, but I love seeing that in a real number. So Brooks, thank you for doing the homework. That was incredible. So this was finances 101, and I think I would be remiss to not like talk about cap rate, right? What is cap rate and how do you go about calculating it? What's the bank's version? And then I'd love Brooks' more operator investment growth definition if they're not the same. Amber, I'm gonna start with you. How do you define cap rate to a self-storage operator?
So, true definition of cap rate is just your NOI divided by the price or your market value. And it helps the owner or investor determine what their rate of return is going to look like.
Mm.
Typically, a higher cap rate is going to indicate, possible higher return. It's typically also associated with higher risk. So think like again, mismanaged older facility that needs a lot of capex and some elbow grease to kind of bring it up to snuff and get it stabilized. Versus low cap rate, it's lower rate of return, but the risk is also typically going to be lower. So, like if you're purchasing a, 3-story, um, highly occupied facility that's been ran really well, it's going to have a lower cap rate, but your risk there is also quite a bit lower. Your return is also probably going to be a little bit lower. Um, that's the general idea.
There we go. I guess Brooks, like from a day-to-day operator, when you're managing a portfolio, does the cap rate enter the conversation until you're ready to sell or buy?
Good question. I think the short answer is no. At some point in my way of thinking about things like customer rate increases, I would say, oh my goodness, we've added $1,000 to our rent this month. That's $12,000 a year. On a six cap, that has made my property worth an extra 200 grand. Um, and am I doing the math right there? Anyway, I've kind of stopped doing that because the cap rate, Amber gave the exact right definition of a cap rate. I say it as your profit divided by the price. It's a real simple way to think about what cap rate is. Um, but if you go out in the world and say, well, what's the cap rate on this? People answer the question relative to what they want the cap rate to be. They answer the question of like, well, I'm buying this thing and I think once I have it going, it's going to be an 8 cap. But if you take last year's expenses and income versus what I'm paying for it, it's a 2 cap. So were you buying a 2 cap or an 8 cap? Well, you're buying what you're buying, right? And so if and every buyer is making his own assumptions, and every broker is making his own assumptions. And so cap rate is very important to think about. The last bit of what Amber said, it's your long-term return on investment. If I'm buying and operating something that is a 8 cap, I've got to compare that to buying a 4% bond. And so that's an important
Mm.
metric on the front end. But once you own it, I don't think you need to get too distracted by the cap rate unless you are trying to sell. I think you need to run it as well as it can be run uh, in every circumstance.
Yeah, no, I love that. Thanks for breaking that down from the financial, the finance perspective and also from the operator's perspective. Brooks, there's two questions that I just spotted here that are specific to your expense budget breakdown. So Abraham asked, what is covered under that protection plan 1% expense? What does that mean? Protection
Ah,
plan. Yes.
so one, Amber names several ways that facilities have different expense ratios. If you're boat and RV and you don't have a power bill and you don't have a manager, you can get away with a very low. If you're all parking, you have no buildings, then your property taxes are going to be lower. So there is a world out there where you can run some facility at 18%. But most of these things shake out pretty consistently. This is one that doesn't. Um, I'm going to make up a ratio and I'm going to say that half the facilities in the country really aren't doing much of a contents protection or insurance plan. And then I'm going to say the other half are. And of the other half, you have this kind of sliding scale. The most effective penetration is something in the 85 to 90% range. And then, a lot of stores have 10 or 20 or 30% penetration. We have about 80% penetration for our contents protection plan. We sell a plan for $14 or $15 a month to 85% of our customers, let's just say. The loss ratios, the actual amount of money that gets paid out in losses of that
Mm.
percentage that comes to us, of the $14 that comes to us, the loss ratio is very small. This is a product where, and by the way, we're quick to pay claims. If we have a claim and the language says, oh, this is excluded, we pay the claim anyway because we want our managers to have confidence when they sell it. We want our customers to get value out of it, and there just aren't that many claims. So there's a lot of profit to be found in a contents protection or insurance product. The REITs are very good at doing this. Most of the REITs, Extra actually keeps 100% of the insurance product. That's one of the interesting things about Extra as a manager. Cube and Public and pretty much every other third-party manager you can find at the top, more or less, they keep half and they give half to you. And so in that situation, according to my expense ratio here, you would say that if, making it up, 7% of your gross revenue came from your insurance plan, 3.5% is going back out to pay the manager to run your plan. So that would be 3.5%. In our business, we have found some very cost-effective ways of providing that plan. And so it costs us 1% of our gross revenue, costs us about a tenth of our insurance revenue to cover the losses and administration of our plan. So that's a very long-winded way of explaining what. Hold on, I want to make sure I'm actually reading the right line. I'm seeing insurance, and what line did he fixate
It
on?
was
What did he see?
it was
Protection plan.
protection plan.
Protection plan. Where is that?
Towards the bottom, right
Towards the
above.
bottom. Oh yeah, also 1%. Okay,
Yep.
I was just making sure I wasn't getting distracted. Yeah, the protection plan. The insurance is our property and casualty insurance, and the protection plan is that 1% it costs us to run our plan.
Love that. Yeah. So great, thorough answer, Brooks and Abraham. Hopefully that makes sense. And then Gary in the comments asked, should management fee and general admin be put together? What would be the difference?
So you notice my little note there about software. A lot of this comes down to whether or not you have a third-party manager. If you don't have a third-party manager, the only person you're paying for management is yourself. And you're paying a manager, but that goes under payroll. So if you don't have a third-party manager, put an X through management fees and just remember that your time is valuable and it is what it is. If you do have a management, if you do have a management company, if you do have a third-party manager, everything you pay them should go into management fees, including, in my opinion, the contents protection slice and other things. I think that's a management fee. Um, then the stuff that goes in general and admin, that is printer paper and maybe your operational software. If you have a third-party manager, they probably provide your software, so that's why that note is in there. Um, your general admin is like, it's like the miscellaneous line. It's all the other stuff that doesn't belong anywhere else. So that's my answer to that.
There we go. Gary, hopefully that's helpful. Love that. So y'all have both mentioned stabilized and that term a few different times throughout this, the conversation today. Again, there's a 101 course. Break this down. What does it mean for a storage business to be stabilized?
I mean, I can hop in here. There are really two different types of stabilization, physical and economic. So physical is going to be your truly like your occupancy of the physical space of the units, how much you've got rented versus how much is available. So stabilized, I would say, I think Brooks used 85, 95% roughly whenever he spoke about it earlier. I think that's a really good number for physical stabilization. For economic, which is usually, especially during like a lease up process, economic's going to kind of follow physical as discounts start to drop off and as you're able to start increasing rents and ECRI. So I really economic stabilization is from a lender's perspective very DSCR based. So we're typically looking at 125 DSCR stabilized. I think you can really say you're stabilized if you have that on like a T6 or a T12 versus like I've got this 125 1 month just to make sure it's not an anomaly and you are truly trending in the right direction. I think having a good number of months under your belt at that DSCR is really good. I think that's a pretty good gauge.
Yeah. Well, you mentioned DSCR, and that was another question I had. So break
Mhm.
that down for us. What is the correct or the safety debt service coverage ratio that an operator should be trying to aim for there?
Well, 115 means you're going in the right direction, I think. So it kind of depends on the project. With a ground up construction project, you may have years before you kind of get to a break even point on your debt. Um, because you're in lease up and you're gonna be throwing out discounts left and right to get the facility filled up. Um, so DSCR, I think, really starts to become very important whenever you get to the point where you are physically stabilized and you're really bringing up that economic occupancy. Um, 125 for us at Live Oak and for most lenders, I would say is a really fair number. And that 25 is really just additional cash that you have left over to, put into other projects, even grow your business, put into your pocket, put into the pockets of your employees, really add on new services, pay more for insurance and taxes. Like it's just it's additional money that you can use, even in some cases towards those things that you don't plan for. So.
Yeah. Amber, can you expand on 125? Gary had a great question there.
Mhm.
Are you referring to 1.25%? Break that down for us.
Yeah, of course. So it's your debt DSCR, debt service coverage ratio, is just what your debt is versus what your NOI is. So what your profit is after all of your expenses are taken out, how well that covers your debt. So if your debt is $10,000 and your NOI is $10,000, you are at a 1.0 times DSCR, 1 to 1. You're at a break even. So anything above that $10,000 is going to be an addition to 1 to 1, and it's going to increase your DSCR. So 125, you just have additional cash on top of your debt service to then reinvest or use towards other expenses in any way.
Yeah, love that. And then Jason said, "What's that?" And I think this is Brooks. I'd love to hear your take on this. What's the average timeline for lease up? 1 to 2 years, longer? Jason, give us some more details about where you are, the type of facility you're trying to lease up. Maybe primary, tertiary, secondary would be helpful too. Give us some more details in the comments, Jason. But in general, Brooks, as a new operator, what am I expecting? Okay, secondary market to Dallas Fort Worth. Love it. 100 units. There we go. So
Okay,
Brooks.
so is it brand new, Jason?
Yeah,
And
Jason,
I'll
is
go ahead
this?
and
Yeah, go ahead.
I'll
Yep.
tell you more than you want. When we are penciling, so one of the
Yes, brand
rules of
new.
thumb people use in the industry is 3% a month absorption. So if you're building 1,000 unit facility, you assume that market will support 1,000 units, and you hope to add 30 net units a month. Now, 1,000 unit facility is huge. So in Jason's situation, 3% a month can only be 3 units. 3 units sounds pretty paltry to me. I would hope that you could net absorb something on the scale of 5 to 10 units a month for your first year. So maybe you end your first year at something like 60% occupancy. But that is only for a very small facility. When we're planning new developments, most of our new developments are between 50 and 80,000 feet. And I will not assume anything faster than 3 years to stabilization at those facilities. If I achieve that, that's great, but I'm not going to model anything faster than 3 years on a new build.
Love that answer. Yeah. So Jason, hopefully that's helpful. Go out and lease up that thing, man. So yeah, 10 to 12% over those first few months is very reasonable for a facility that size and in a secondary market too. So love that. Well, Brooks, do you have any thing to contribute to the stabilization conversation? Any takes there as an operator, as far as what does it mean to be stabilized, even the debt coverage ratio? Like, are you, with the portfolio of your size, are y'all leveraging debt, or is this all cash at this point, or is everything outright owned? What's the situation?
No, we are, when we build or buy, we are starting out with something in the scale of 70% leverage.
Okay.
We, Our global leverage today is something like 30 or 40%. So we have been fortunate that values have risen and we've retired debt, and not gone back to the ATM too many times. So our global position is strong. But to Amber's point about the 1.25, we acquired 3 facilities in a single transaction about a year and a half ago, and they were in lease up, and the lease up's gone poorly, and so they're at a 1.0 debt service coverage. I'm having conversations with a bank right now where they're saying, "Hey, we wanted these to be at a 1.25 and they're at a 1.0, and that stresses us out." And I'm like, stresses me out too. And so, you got to have this conversation about what do we do now? And I'll kind of loop this back to stabilization. Stabilization is it's like cap rate. Like on the front end, you better know what you're aiming for. You better know how many square feet you've got. You better have a sense of what a reasonable rate per foot is in that market. Let's say $12, $15. And you better know what your stabilized revenue is and be aware of it. And then when you're running your facility, there's an old saying, plans are worthless, planning is essential. When you're running your facility, who cares what your original projections were? You run your facility every day to the best of your ability and you optimize for that real situation. Not you can't twist all your customers' arms and say, you got to pay me more. I had a plan 3 years ago. If your current occupancy is 80%, it's been that way for 24 months, that's probably your stabilized occupancy unless you can bend the curve somehow. So I wouldn't get lost in whether or not your facility is stabilized. I would think in terms of it takes 3 years for a facility to mature, and then I would think every day I've got to run this as well as I can.
I really love that. That's another grown-up answer from you. No, no surprises there. So this is related. So I'm going to ask it. So we had, before the show started, we had a few questions, and I checked the audience list, and they're both still on here. So I want to ask the questions from Irv, who operates the Southern Star Storage brand, and Linda Ryan, who operates Flowery Branch Mini Storage. I'm going to ask Irv's question first, since we're kind of here on this CR conversation here. His question is, when acquiring or building a new facility, what are the pros and cons of DSCR versus DST funding? And DST, and that was what was sent in. DST, I'm imagining
Amber?
Amber. I'm gonna have you
I
take
have
this
no
one.
idea what DST
Yeah,
is. I'm going to be honest with all of you.
yeah.
I don't either. I was like,
I
I'm
know it
chat
that
GPTing
yields, so
this as we talk.
we'll
I
listen to
Um,
that
Googled. I had to
yield.
Google it, Irv. So Irv, you're in the
Okay.
audience, so if you can chime in what you meant by DST. But I Googled DST, and I found something called the Delaware Statutory Trust. Uh,
that's a
Um, no,
I can
I'm
talk
not
about a
aware.
Delaware statutory trust, but that's not exactly in the same line as DSCR. Is that what Herb meant? I can do a minute on Delaware statutory trust, but it's
let's define because I this is the first time I've ever heard
so
of the term.
Yeah, I have no
they're
idea. I've
basically
never
out of
heard.
favor right now. There was a
Okay.
moment when interest rates were such that it was a really interesting way um, to do a version of a tax-free deferral, and you basically could raise money. So the Red Dot was the group that did this the best. They went out and raised they once a deal was successful, so they built a facility or bought a facility for $2 million, and then once it was worth $4 million, rather than selling it outside the company, they sold it into a Delaware statutory trust for the $4 million, and that DST paid out a bond of something like 4%, and it was a way for them to capture value of the facility without fully selling it. Similar in a way to what people do with CMBS. It was a very sophisticated financial move that didn't end up working out great for them, and it's not that is like a 401 finance maneuver. It is not something that I would expect anybody on this call to be um, trying to nail.
Yeah. So Irv, if I'm understanding your question, I would probably say typical debt service loan finance option might be the cleaner option probably
Yeah, yeah,
than
you're
to do a
not.
401 level. That'd be but obviously every situation is different. So Amber, do you have anything to add there?
Yeah, I think you've got a lot of different options. I think that I think you mentioned this was an acquisition. For an
Hmm.
acquisition, I mean there are so many types of debt products in the market. You can look at conventional bank debt or SBA loans or USDA loans or CMBS or Life or seller financing. I think is a really big one, very highly talked about these days. Or even tandem financing with a seller in a bank. There are so many options. I would say a large majority of those are, at least in some way, shape, or form, DSCR focused, just
Okay.
because they do want to see the cash flow of the facility. Um, I think a lot of banks will also underwrite to like a projected basis, which can be especially helpful if it is a facility that is going to take some turnaround, versus some other products may only really want to work with stabilized assets. So, got
There
a
we
lot
go.
of different options there. Sorry, I
Yeah.
don't know much about DST though.
Yeah.
It's
Irv, hope
a
that's helpful.
great
Yeah.
explanation, Brooks. Thanks for that.
Yeah. Irv, congrats on the potential new venture you got there. So awesome, man. Linda's question from Flowery Branch was, what interest rate should owners be looking for when they're going to finance or refinance their storage business?
Yeah, I think as far as if you are a current owner and you're looking at conventional bank debt, I think there is a lot in flux right now because rates are moving on a downward trajectory, which is great. I think that you could probably expect to be in the sixes for the most part on a conventional loan. On a refi, anything CMBS or life, especially with larger portfolios, may be a little bit more aggressive on rate. And anything SBA wise is most likely, especially 7As. 504s are pretty competitive on rate, but 7A loans typically really appropriate for brand new folks starting out in the industry for the first time. Those are going to be a little bit higher, probably in the sevens.
Okay. All right. Brooks, do you have it? Do you have any tips on navigating the financial world as a portfolio manager and an asset owner?
I do it a little differently than most. I sign personally on my loans. I have close relationships with my banks, and I borrow cheap. And so my loans are generally fixed at 5.5 or below, or floating at somewhere in the range of 200 over SOFR, which in the general real estate world, that is, I mean, Amber can give us her two
That-
cents, but we find
That's
those
better. Yeah.
rates to be pretty low. Um, the you can move toward debt where you are not guaranteeing the loan, and you can move toward other structures and pay a little bit more for the money. And some people sleep better at night that way. I sleep better at night knowing I'm saving $1 million a year in interest, but choose your poison. I the I will make a note for people who hadn't gotten deep enough in this. I have not personally done an SBA loan, but I've got two or three friends that have done them, and the general summary I've heard is that they are laborious. They are a headache. They have a double closing. Every T is going to get crossed. It is not going to be the cheapest loan on rate or upfront fees. But what it allows somebody to do is effectively put more leverage on a deal than they could otherwise. Said another way, it allows them to own more of the deal than they could otherwise. So the friends for whom this has worked really well, they might have $500,000 and they are able to get a loan and they're able to build a $5 million facility or buy a $5 million facility. If it weren't for the SBA, they would have to go raise $1 million, put it with their 500, and now they have had a hard time raising the money, probably can't do it. Even if they can do it, they now own a third of the facility. So this is kind of like guaranteeing the loan. And I think SBA loans are guaranteed. Amber can explain that for us better. Maybe it's partially guaranteed.
Honestly, yeah. Break us down. SBA. Assume we don't know anything about SBA alone.
Ooh, so what I will say is, Brooks, your friends and their experience with SBA loans is pretty on the spot for a lot of people's experience with SBA loans. Um, they get a pretty bad rap, and for in some cases, good reason. It is just a totally different process than a conventional bank debt loan. Um, there is a process with an SBA loan, specifically a 7A. So there are two different types of SBA loans, a 7A and a 504. 504s do have multiple approvals. You're working with several different parties. So it is more cumbersome. There is more paperwork. There are more hands in the pot, so to speak. But you can finance a really large project up to 15 million bucks in debt, up to 85% or even 90% leverage. So the leverage point for really large projects can be really beneficial, as you mentioned, for that loan type. For a 7A loan, I am very fortunate to work with the lender that I do, because we do more SBA loans than any bank in the country. It is our bread and butter. And I think the important caveat with a 7A loan is, if you work with a lender, any lender, if they are what is called a preferred lender, where they have a designated authority kind of status with the SBA, it feels a whole lot like a conventional loan in a lot of ways. It just moves smoother. You don't have to, I don't have to, if I'm working with a customer on a pretty quick turn acquisition, I don't have to take my credit approval and send it off to the SBA for their okay. The SBA just says, you're good, you're a preferred lender. We know that you guys are making the decisions you should be. So I would say if people are looking for SBA loans, there's a lot of benefit there. They do have some higher fees. The rate is going to be a little bit higher because of that leverage point. But they're backed by the federal government, so lenders get a lot more comfortable with them, generally speaking, because of risk, especially with newer folks in an industry. Um, and there's just there's kind of like a give and take there a little bit, I would say. But if you do go the SBA route and you're working with a lender, make sure that they are preferred lender. It will make a huge, huge difference in the process.
Love that. Good advice. Now I feel like I know what an SBA loan is. Thank you, Amber GPT. Uh, so I saw this comment. I was scrolling through the comments, and Brad had a couple of really banger questions. I'm going to ask them here as we're kind of heading towards the end of our time. But since we're on this loan topic, right? So Brad asked, "Hey, what are some smart options to refinance a bridge loan after building and leasing up a new facility? Can you refinance through SBA?"
Yes.
Ah,
You can. Or you can conventionally. It just kind of depends again on really the scope of the project and the guarantors, right? Because if there's more risk there, which this would you would be past construction risk, but you still have that risk during lease up.
mm,
So there is more risk associated for whichever bank you're working with. But yes, you can refi through SBA. You can refi conventionally, and we look at it as kind of like an at CO, loan. We're typically building in operating capital, so banks will often like look at your lease up and look at what your operating deficit is and build in a reserve for that. So that you're covered. It brings a little bit less risk to the table
yeah.
to go that route.
Brad, you should call Amber after Gabfocus today. I'll share her contact info with you. I think that'd be good. Now, I want to ask Brad's question. Linda has another question, and Michael's got a question too. So those are my last three questions. And y'all, we got halfway through the agenda. So Well, we may have to do part two. So the other question Brad asked, I think is a really smart one, is, hey, what would cause you to think about selling a facility? What metric would you look at to determine if it's better to sell or explore other opportunities?
Brooks, you wanna?
Yeah, I get asked this a version of this question fairly often. Hey, what would it take for you to sell? And for me, trying to grow a portfolio, the question's actually a little more textured. It's really how fast do you want to continue to grow? Every choice to not sell is a choice to rebuy my facility at today's market rates. And so one of the first questions you got to ask yourself is, if you call two brokers, get their opinion of value, deduct 300 grand, and ask yourself, would I pay that for my facility today? And if the answer is no, if the answer is I don't think it's worth that, then you should sell. I mean, economically, if you
Wow.
think if you would not pay within a reasonable margin what somebody else would for your facility, then somebody else values it more than you, and I think you should seriously consider selling. The second way I answer that question is from a totally different angle. Where are you in your life? What do you want to be doing? And if you want to move to a different city, or you want to invest your money in a different sector, or if your kids just left the house, or you just got married, or you just had a baby, use those things to answer the question of how this fits into your current life strategy, and kind of come at it from that perspective. If I get suspicious of people who are like, I found the golden goose. I'm going to go put it all in crypto, or I'm going to, it's no longer storage. Now it's multifamily, or now it's a lawn business, or now it's, like, I think that the markets are painfully efficient, and allocating your time and energy, your time, talent, and treasure to any particular sector should probably have similar long-term expected outcomes. And I've got a lot of inertia, momentum in storage. It's the thing I know best, and so that's part of the reason I continue doing it. But part of what I'm naming here is there's no one answer to the question of when you should sell. If you're looking for the economic answer, figure out what a broker thinks it's worth and ask yourself if you'd pay that. And the other questions are really the harder and deeper questions.
That only you can answer, Brad. Beautiful, beautiful answer. You're so articulate. I love you. That's awesome. So two more questions. Linda asked, and this is honestly related to she submitted this before the show, but it's really related to your expense breakdown that you shared earlier, and that was, what percent of revenue should I be budgeting for advertising and promotion? In your data, in your 39%, 1% was marketing. So would that be your answer, or do you have more thoughts for Linda?
Always got more thoughts. I am. 1% is an interesting kind of no man's land. I think half or three-quarters of the facilities in the country probably spend zero. But Tommy and I have had a lot of discussions about AdWords, and Tommy, I'm so impressed that you have not once mentioned, StoragePug here. Spending money with StoragePug is a form of marketing.
Tis true.
And
Tis
you
true.
can spend as much or as little as you want on marketing. I have an internal sense that if I am paying for, let's say, more than 20% of my move-ins, if I'm paying Sparefoot or Google Ads for more than 20% of my move-ins, I'm probably doing something wrong. I think I need to be attracting most of my move-ins through my everyday way of existing in the universe, and through my customer service, my visibility, whatever it is. And then I can kind of pay to juice that at the margin. And the way that most people are doing that is AdWords and Sparefoot. The next tier of marketing, I want to have great signage. I want to have a great website. I want to have good street presence. I personally love to sponsor the high school football team, or the thing that I think has visibility in the community and reminds people that I'm a supporter of the community. That's not really an economic decision as much as it is just a goodwill thing. Um, but if your marketing expense gets above, let's say 4, 5, 6%, I would say you're outside the norm in storage. And if you're spending zero, you should spend something. So 1% is a bit of a placeholder. It varies for us seasonally. It varies by store. And one last anecdote here. The guys who run 10 Federal were bragging to me that they were able to radically cut their operating expenses. And we've talked about this, but I'm like, man, I don't know how to cut my operating expenses. What'd you do? And they're like, we just stopped paying for marketing. And I was like, oh, that's a way to do it. So they cut their operating expenses 4, 5, 6%. And and they were confident in their internal analysis that it came back out in the wash. So marketing is all over the place.
Yeah, I think the that's a great anecdote, right? Because I think there's a voodoo. It feels like a black box to a lot of operators to spend money on like paid media, like Google Ads, for example, specifically Google Ads, honestly, and because the lack of tracking and also like, yeah, you're during the lease up season, or leasing season, you're probably going to rent units regardless of whether you run money on ads, right? So it's the question becomes what's the marginal increase? If I'm going to rent 30 units just by showing up with good signage, all the other things that I'm doing, how many more am I going to get if I spend $1,000? And I think that's the question. And I think sounds like Ten Federal and Andrew and those guys over there took the bet that we're going to rent the same or marginally less that it's not going to matter. So yeah, I think that's one way of doing it. I think it's very interesting. Well, right on. So one last question from the audience, and I'm going to jump into the question of the week. Y'all, thank you so much. Michael asked, he was actually one of the first to send in this question earlier. So this is more to do with investments, diversifying the way storage is done. So if are there others beyond standard storage, right? Like this flex storage space, right? Where you've got bigger units, bigger areas for subcontractors, that sort of thing. Um, beyond like somewhere between a storage unit and like an RV park, right? So what's the any help, any ideas, any suggestions for someone who has land and doesn't think that building self-storage, traditional storage is the right choice, and they want to explore things like flex storage.
I get pretty excited about this question
Okay.
because we have seen a pretty, I mean, I would say like a really legitimately good uptick in newer projects with contractor units and with not necessarily flex space so much. Depending on how you look at it, I think is probably perspective. But we have seen a lot in the contractor unit kind of space as far as new development goes. And I've done a couple of projects where they build in, a couple of contractor units or, 5 units, 10 units, and they fill up so fast. They're an incredibly sticky unit type because people will, they're much more likely to stay there for a longer period of time. If they're storing like large equipment there, even if it's like I have one customer who had really good luck with car dealerships in the area located, like car dealerships are kind of um, typically side by side very often. So there are a ton of them that need a huge amount of storage for Christmas lights. And so it's kind of stuff that you don't even really think about, but there's I think a lot of opportunity there. Um, and the tough part is there aren't a ton of comps in the market. So a lot of it is kind of like, throwing a dart and seeing where it lands. But it is exciting. It feels like it's a new part of the industry that's becoming more and more talked about, and we're seeing more and more of it on the unit mixes on our side too.
I love that. Brooks, do you have any exposure to this beyond traditional storage kind of space?
Yeah, so our name Flex Storage, we kind of chose that somewhat intentionally. We want the customer to understand we're flexible. We want our team to understand that we're not in one business for one purpose. We're trying to be out there, kind of understanding what else makes sense. We have a little bit of traditional flex space, and what Amber said is exactly right. I think the contractor garages. A lot of times people will build RV units at a facility and then find that only half of them are rented by RVs. The rest are rented by businesses with with needs for something more like a flex unit. You could kind of think that anything over 400 square feet is kind of bigger than a traditional storage unit and in a different category if you're trying to differentiate it. I try to build some large units at every facility if I can. They always do well. Some municipalities fight you over 400 feet. They think it's a different line of business, which maybe it is. Um, I think if you've got a parcel, the parcel probably needs to dictate what you can build there. The traffic, the zoning, the local, area. And so I'm loath to say you should build flex instead of storage or storage instead of flex without deeper, insight into the exact situation. But I do think metal buildings cost what metal buildings cost. You're building a very similar product, it's the same slab, it's the same overall process. And I also think that the rents and expenses work out to similar numbers as well. So Amber's point about stickiness is right, and there's some other advantages to flex, but there's also a few disadvantages. And all in all, I think it's a great first cousin to storage.
There we go. Yeah, Michael. I've also got a good friend and client of fellow Pug Pack, James Reed, who's building a flex brand. So I'll get you intro to James at some point so you can.
James and Tommy are the two friendliest guys in the storage industry.
Yeah. Yep. Just about to say the same thing.
James is a good dude. We've crossed paths for many, many years, and he recently joined the Pug Pack. And so, yeah, I'll get an introduction email sent shortly and get y'all introduced, and you can talk about flex space in Arizona. Question of the week. We talked about so many things today, y'all. From very practical things to nerdy things to financing. So it's going to be hard to summarize, but I want you to summarize anyways. Amber, I will start with you. What are your top three pieces of financial advice that you'd give to any owner or operator in self-storage? Top three pieces of financial advice. Amber, go.
Yeah. So, I mean, I think in part, I guess working with this is all from a lender's perspective. So it's nice to have both kind of perspectives here, but from a lender's perspective, whenever you are looking for debt, I think if you're looking to grow your business and you're looking for, new facilities or ground up construction, be transparent with your lender and expect that same transparency in return. Work with someone that is open and honest with you and kind of keeps you up to date throughout the loan process. Like Brooke said, he has a great relationship with his lender. There's a lot of benefit there to, especially as you're growing your business and growing your portfolio. I think that's one. Second one would probably be surrounding yourself with a really good team. So lots of vendors in this space. Um, can't remember if it was at the beginning of the call or in the lobby talk, but I said it's the people in this industry, right? There's so many good people. So I think finding the right team that works for you and your project. And I think whether it's, like marketing and third party management, access control software, whatever it is, they should be there to support you and it should make sense for you and your project. Um, and then I'd say self-storage is not a passive investment. It's still very active. So being involved in your day-to-day, knowing your data, at the end of the day, even if you have third-party management, you manage your manager, right? So just being very active in that ownership and rolling with the punches, I think is really important. Was
I
that
love
three?
that.
That was three,
That
right?
was no killer. I love it.
Okay.
All three of those are
Okay,
brilliant.
good.
I love where you started. Yeah, be open and honest with your lender. They can't help you if you don't give them as much details as.
Really everybody, but
Oh, that's true
from my
too.
perspective, like, and expect that same transparency. I think that's just
Yeah,
as important.
I really love that. Brooks, what's your top three pieces of financial advice?
Um, I thought about this a little bit in advance. Here they are. One, be in real estate for the long run. Um, Warren Buffett has a line about buying a stock. He's like, if I buy a stock and the stock market shuts down for the next 10 years, I'm fine with that. I want to own that company. I bump into a lot of people and who perceive real estate to be a game of in and out. And either those people are smarter than me or luckier than me or something. I think that I think real estate takes a long time to season and mature. I think you've got to be able to save some reserves for a rainy day. I think if you're trying to time the market, the odds of things going wrong are not fantastic. So I would say treat it like you're going to own it forever. Care for it that way. Fix problems that way. Fix the roof that way. Fix the parking lot that way. That doesn't mean spend as much as possible, but treat it like these problems are going to be your problems for a long time. And I think you'll end up with a better outcome that way. Number two, learn everything you can about the business. I love, Amber's point that it's not a passive thing. When people talk to me about mailbox money, I'm like, mailbox money always seems thin to me. I don't. I guess if you bought Nvidia at the right time, that might be mailbox money. But again, I can't time things that well. So For me, I want to learn everything I can about my business. I want to follow the air conditioner guy around, ask him what Freon is, spend time staring at your utility bills, understand what a kilowatt hour is, call Tommy and ask him, what some metric on some StoragePug report is that you don't understand. Uh, Try to get deeper than you thought was necessary in every corner of your business. That knowledge compounds. I was listening to Brad Mensley of 10 Federal answer a guy's question. He was like, "How do I develop this site?" And Brad was like, "Well, if I were you, I'd go get a Bobcat and I'd start moving dirt." And that's part of Brad and 10 Federal success. They actually did it. Nobody does that kind of stuff. Harold Elrod is a guy I'll name here. He went and put his RV on his site and did his own. He staked out and then did his own topo and then put it all into Excel and balanced his own site. I love it when people get that deep in their business. And so that's my second piece, learn all you can. And then the third one is think of your opportunities in terms of pipeline problems. If you are trying to figure out how to get full, figure out how to build the biggest customer funnel you can. If you're trying to hire, don't think, how do I find somebody to fill this role? Think, how do I get five good candidates in here, in the next week? If you're trying to buy, think, how do I fill an acquisitions pipeline? If you're making a decision between one thing, you're going to make a subpar decision. If you're making a decision between five or 10 things, or if you have levers you can pull in different directions, you're going to end up in a better place. So, fill pipelines would be the third piece of advice.
Yeah, no, 100% love it. You're such a grown up. Love you. That's awesome.
I don't know
Y'all,
if anybody's ever thought I was a grown up before, Tommy. You've paid me that compliment three times on this call. I feel like the white in the beard is coming through.
it's coming through. It's speaking to me. Y'all, incredible episode. I wanted to share this comment real quick because I think it's freaking dope. Y'all, thank you for everyone who participated in the end of show poll there. Getting the was my favorite quote here. The question was, what's your favorite part of the episode? Getting answers in regular English to help us understand complex issues. Brooks and Amber did an absolutely phenomenal job. They're clearly so knowledgeable. Mwah. Y'all make me look good. So thank you for coming out, y'all. For the audience, in case they want to get a hold of you to learn more, Amber, what's the best way for people to learn more about you, how you can help them, SBA loans, DSTs,
Probably not that.
or
Probably not
maybe
that.
not DSTs,
That's probably not me. Yeah.
but anything else about Live Oak Bank, where can they find you?
Yeah. I mean, I am at many a trade show. We always have a booth at I would say the large ones and most of the smaller state shows. But I'm available email, phone call. If anybody has any questions, just general questions
Yeah,
about
cool.
anything financing specific, happy to help with that. I also host office hours every other week, which is just a general
Oh,
education
love
session.
that.
Yeah, so if you have any questions, it's a good way for people to kind of, I think, uh, bounce ideas and questions off of other folks, whether they're owners or trying or very green beans. As
I love that. Where can we get more info on these office hours, please?
so the office hours are me and Tyler, Tommy, actually.
Ah,
We split them up. We go back and forth.
okay, okay. How can I sign up for these? Is it online? Is it on y'all's website somewhere?
Yep, it is out. I will pop the link in the chat if that works. But it's
Yeah,
um I'm sorry, I can't talk and type at the same time.
very good. Yeah,
But yeah, I'll put it in there. I think it's again, it's just a good
that's
conversational meeting. We host it bi-weekly every other Wednesday. But again, if you have specific questions for me, feel free to reach out to me directly.
yeah. I
Um,
really love the live office hours things, man. That's killer. That's
it's
freaking
fun.
awesome.
It's good.
Yeah.
It's a
Sweet.
good convert. Well, yeah, I think it's just a good opportunity to hear questions that you may not have even thought of,
Yeah.
and then vice versa. Other people aren't thinking of the same questions you are. So,
There you go. Perfect. Brooks, same question to you. If folks want to learn more about what you do, how you can help them, or maybe just want to learn how to follow in your footsteps, how can they find you?
Um, I'll put my email address in the chat. It's Brooks well, I'll put it in the chat because
I
I
do.
have to say it twice. But flexstorage.com is our company website. You're welcome to look at that and uh, reach out anytime. I'm probably only 50% for responding to emails, so you may have to reach out twice. But I obviously enjoy talking about this stuff. I enjoy thinking about it, and really
Yeah.
appreciate the opportunity, Tommy. You Tommy compliments so many others. I'll just say that Tommy has been a persistent source of warmth, insight, and intelligence in for the last 10 years as I've kind of been exploring this business. And I'm not a member of the Pug Pack. I'm not a customer, and I can call Tommy at 3 in the morning and ask him a question, and he has got two answers. So I just want to say thank you very much.
Yep.
No, you're very kind, man.
And Tommy, you
Just,
and the Bug Pack, amazing human beings. Like 11 out of 10.
thanks, y'all. No, y'all
Yeah.
incredible people. Brooks, are you working on any projects that you want to share with the audience today, or you want to keep that under wraps for now?
Um, I'll do a little teaser. We are building some internal software that helps us with a number of things. Revenue management. It links into our Google AdWords. It links into our Google reviews. It does a number of things, and we have a desire to kind of share it with others. It's not quite ready for prime time yet, and the sad thing about software is it's always 2 weeks out, so I don't know exactly when we'll have arrived. But I'll put my email in here, and if anybody's interested in that, it primarily runs on storage, and I know most of the Pug Pack is not on storage. So, especially if you're on storage, reach out to me. But we're working on the site link compatibility. So if that's something you want to see in the future, reach out.
There we go. Hit up Brooks. Y'all, thanks for the kind words. Keith says Tommy is such a grown up. We're all grown ups today. So y'all, thank you. This episode, if you want to catch I mean, there's so many wonderful golden nuggets in this session. I've been slacking my team behind the scenes and hey, there's a great snippet here. There's a great quote here. We want to definitely capture it. So lots of good stuff. Catch this on the Gabfocus official storage podcast. Check it out on YouTube. Join the Facebook group. Catch all the replays. Next up is the week before Christmas. Lessons learned in 2025. We've got a whole posse of people. Shannon from XPS, Jane Sauls, Heather from Spacebox, Melissa should be back for this one. It's going to be a party. Come join us. We're going to learn about all the things that happened this year, talk about what's going to happen next year, and just celebrate the year that we've had together. It'll be our official 79th episode, which is really, something really fun. We've been doing this for 5 years, which feels crazy to say. And we're very honored and very appreciative, especially heading into Thanksgiving, the season of gratitude. And yeah, needless to say, I'm so thankful for this industry. It's afforded me such a fantastic career and my life for my babies and my wife. But also, yeah, we have a team of 40 people at StoragePug that depend on self-storage to feed our families and feed, and have a roof over our office. It's just fun stuff. So I'm very grateful and thank you for all the folks who showed up today. And at one point, I think we had over 200 unique people pop in today. So thanks for coming out. And Brooks and Amber, much appreciative for you all to spend well over an hour today dropping some great knowledge. And y'all, seriously, if you're still in the audience, I really hope you reach out to Amber and Brooks. Their wealth of knowledge, and they're very generous and gracious with their time. So guys and gal, thank you so much. Y'all have a great Thanksgiving.